Okay, well, we've got Cameron Brandt joining us now. He's Director of Research at EPFR Global. Cameron, good to have you with us here. Thank you very much for your time. It's always about the flows at the end of the day, which determine prices, although people could say that it's the opposite as well. It's circular, in fact, and perhaps it is. But what are flows doing, especially, into GEM funds, into India-dedicated funds? What's the latest data telling you?
Well, since we last talked, the pattern that we discussed then has actually held up fairly well. I don't know if well is the right word, but we continue to see outflows from GEM funds, but fairly solid inflows into most of the major single country Asia funds, funds dedicated to India, Japan, Taiwan, and Korea. On the fixed income side, obviously a lot of stress in those markets, but from a fund flow perspective, investors are building up their position in higher yielding sovereign debt and aggressively cutting riskier fixed income classes.
Cameron, hi, good morning. This has actually been a couple of months where foreign investors have pulled out or redeemed money from the Indian markets. Do you think that's going to be the trend for the rest of the year as well?
Well, it's very much sort of two forces at work. The redemptions from diversified funds, it's not only the GEM funds, but it's the truly global funds as well that are getting hit. Are definitely, sucking money out of India. India itself, though, remains very much in the good column for investors who are focused on emerging markets. And what we have seen recently is a shift away from taking on diversified exposure to going market to market. So dedicated India funds remain on a winning streak. Again, though the totals have dropped a bit in recent weeks, still seeing above average flows week in, week out. The problem is, how much needs to come in to offset those GEM fund redemptions.
Hi, Cameron. Good morning. Good to have you in. Give us a broader sense. U.S. yields have spiked up. So how are you seeing flows towards the bonds in comparison to equities? And within equities, what are the flows between emerging markets and developed markets? Have you seen a change, say, in the last, month or so?
No, I really haven't. Certainly on the equity side of the equation, emerging markets continue to do better, though, again, there have been betters in the not too distant past. Compared to developed market funds. And within that universe, there's definitely a big bias in favor of the emerging Asian markets. Most weeks, bond funds are taking in a bit more money than equity funds, but overall flows are fairly subdued recently. We're not seeing sort of big blowout numbers week by week.
Cameron, just curious to know, you must have read that tweet from Bill Ackman, who runs Pershing Square, widely followed and pretty generous with his opinion, especially on X now. But he said, well, they've covered their shots on U.S. bonds. Said, well, there are too many risks in the economy. The economy is slowing much faster than expected. What are you seeing in the U.S. bond market? And what are the dynamics there? The top dominating drivers to your mind.
The top dominating driver is yields higher for longer. There remains a lot of people here, both institutional and retail investors who've been trying to operate in a very low yield environment for a decade. So at least I think for the next few months, the demand will probably hold up surprisingly well for U.S. sovereign debt. Into next year, I can only agree that there are risks from all directions. And a thing we are starting to see is having accepted the consensus that U.S. interest rates will be higher for longer. The fund flows are indicating that energy prices are now also expected to be higher for longer. We're starting to see flows into dedicated energy funds really accelerate.
All right, we'll leave it at that. Cameron, thanks a lot for joining and appreciate your thoughts here on CNBC TV 18. Let's